Hey everybody, this is Dan back with another Mortgage Explainer, and today we're going to be talking about what does points mean when it comes to a mortgage. What are points? How do they work? And should you pay points? So those are some of the things that we're going to be talking about today. If you have a chance and if you enjoy this content, please do remember to share this video, drop a like, subscribe to the channel. Really do appreciate it. And let's get right into it. So what I want to use to explain what points are is an example for a 30-year fixed rate mortgage using a loan amount of $350,000 and an interest rate of 7%. Okay, now I'm not advertising this interest rate. They change daily. It depends on a lot of different factors what the rate is that you're going to be able to get. Just for the purposes of this video, I'm using 7% as what we call the par rate. Okay, now when I say par rate, that's usually when somebody calls and asks lenders what their rates are. What they want to know is what's the par rate? What's the best rate that I can offer where I'm not charging anything additional as far as the closing costs. So just regular closing costs based on the scenario, the program, credit score. So we're assuming with this scenario that 7% is the interest rate where there's just the regular closing cost being charged but no additional points, okay? And here's where the conversation of points comes into play. Because if somebody doesn't understand how points work, they could contact a lender, and that lender could say, well, I'll get you, 6.75%, right? Sounds great. It's lower than 7. Everything sounds much better. But what you might not realize is to get that lower rate, you might be being charged points or additional costs in order to get that rate. So let me explain, okay? So again, I'm under the assumption that based on the scenario, 7%, when I'm looking up pricing for a client and the interest rates, 7% is, again, regular closing costs where maybe you're paying an underwriting fee, just the other regular third-party closing costs, things like that. But I could also show a client too, okay, well, 7% is, the par rate, there's no additional costs. I can get you 6.75%, right? Now, doesn't that sound great? Better than 7. I'll take it. But typically what's going to happen is that there's a cost in points in order to get the lower interest rate. Okay, so again, just as an example, and this is probably pretty close to what the costs are with the rates too, but it changes daily, okay? So again, just as an example, I'm going to assume that to get that rate down to 6.75%, that's going to cost 0.5% or 0.5 point in costs additionally to buy down to get that lower rate. Okay, so here's how I'm going to show that. So first off, at 7%, let's take a look at what our principal and interest payment is. And again, this is assuming a 30-year fixed rate mortgage, loan amount of $350,000, 7% rate fixed for 30 years. Okay. So the principal and interest payment in this situation is $2,328.56, right? So I have this up here. So you can see 7% at $350,000 loan amount at 30 years. Principal and interest payment is $2,328.56. So that's fixed as long as you have this mortgage for the full 30 years. If you make the minimum payments, that's what you pay over 30 years. Okay, now let's take a look at the 6.75%. So 6.75. We key that in there, and now we can see that your monthly principal and interest payment goes down to $2,270.09, right? Cool. So our monthly payment's lower, but again, what I was explaining up front is that this is with the assumption that to get that lower rate, you're going to get charged 0.5% in points in order to get that rate. Now, not to overly complicate it, but you can continue to add on. So maybe, for example, to get your rate down to 6.5%, you'd have to pay 1 full point. And by the way, the 0.5% or the points, it's based on a percentage of your starting loan amount. Okay. So for our first example here, to get it down to 6.75% with the rate, I was saying that may cost you 0.5 point, so 0.5% of the loan amount. So when you times your loan amount, $350,000 by 0.5%, that's $1,750. So that's an additional $1,750 that you have to bring out of pocket into closing in order to buy the rate down to 6.75 in this example. Okay, so now let's think about that. Well, so $1,750 is what it would take to get the lower rate. Yes, your payment's going to be lower. Your payment's going to be lower by $58.47. Okay, now let's take that cost, that one-time upfront cost to buy the rate down, the points, so $1,750, divided by the total monthly savings, which is at $58.47. So that means in order for this just to recuperate the cost that you're paying to get the lower rate, it would be almost 30 months, okay, or 2.5 years is about the break-even point. So if you're asking, does it make sense to pay this extra $1,750 to get the lower interest rate? Well, it's only going to make sense if you're going to keep this loan for longer than 30 months. Now, you might be thinking, well, it's a 30-year mortgage. You know, if my break-even point is 2.5 years, that's pretty cool. Then after that, I'm going to be saving money for the rest of my 30-year mortgage. That's correct. But what are the chances that before time goes on here, before your 30 years is up, that at some point these mortgage rates maybe come down and you decide, hey, well, guess what? Now rates are at 6%. Contact my lender, or the lender contacts you, is how I, like to keep track of it for my clients. And we say, great news, rates have come down. We can do this, refinance, and we can get you a lower rate down 6%. We can cover your closing costs and show you some different options for that refinance. And so you can pay the loan off. There's no prepayment penalty. So whether you refinance, you sell the house, move, obviously winning the lottery would be nice, pay that thing off altogether. But hey, that's not expected, right? But maybe with rates being high right now, you're thinking that, hey, within the next couple of years, I'm hoping that mortgage rates are going to come down. And if you end up paying this loan off before that 2.5 years passed, then it would have made sense to not pay the points, take the 7%, save the money in your pocket right now, and then take advantage of that refinance in order to get yourself a lower rate in the future. Okay, so those are the things that you have to think of. So again, points is the opportunity to pay extra money up front, to get a lower interest rate up front, but then again, you have to weigh the cost of paying extra for that lower rate compared to the benefit of the monthly payment. It's good to think about when your break-even point is, so do I anticipate having this same loan for the next 4 years to make this worth it to pay the points? Or do you think that there's a good likelihood that you'll pay this loan off with a refinance or selling the property before it's going to actually save you that money? Which would have been the reason that you were paying the points in the first place, to make it make sense and save you some money. So hopefully that makes sense. And again, there's many different examples. We could have said, okay, to get it down to 6.5%, it would cost you one full point, which would be 1% of your loan amount, $3,500. So your monthly payment would drop more, but then the time to make that up, might be a little bit different too. So if you have any questions about this, if you want me to run a specific example for you, I'm always happy to do so, and I appreciate you all stopping by and watching this video again here too. I really do enjoy doing these. I will look to put out another video here soon. Hope you all have a great day. Thank you so much.